Thank you for joining us today. My name is Nicole Offerman. My colleague, Rachel Moran, and I will be discussing cash flow and saving strategies on what to do with my money, developing a savings plan to fund your goals. RTD is a registered investment advisor with the SEC. The material we will be reviewing today will be general in nature and focusing on best practices. Everyone's situation is different, so if you have questions regarding your personal situation, please contact Rachel, myself, or anyone on your RTD team for individualized questions. As the Director of Retirement Plan Services, my focus is on our employer retirement planning clients and their participants. Planning for retirement is a major financial concern for many individuals, but it may not be the most pressing for your current situation. We find incorporating education on the specific retirement plan with financial planning topics that arise throughout life helps build confidence to know you're putting your hard-earned dollars to work for you to attain your goals.
And as Nicole mentioned, my name is Rachel Moran. I am the Director of Personal Wealth Management as well as a Senior Financial Planner at RTV. So my day-to-day work, I work with individuals and families to help plan for their future. And while it's often focused on retirement planning, today we're going to be spending some time discussing just the basics of money management, how to set financial goals, how to save for them and determine the appropriate accounts to save for those goals. So we hope that this provides a nice basis of education for you as you begin to plan for your future. So when working with my clients on financial planning, we cover a lot of different topics. We think about tax planning, retirement planning, investing, considering your estate, planning for the distribution of your estate upon your passing. We look at insurance policies, life, disability, auto, homeowners insurance. We consider charitable giving. Today, we're really going to be focusing our conversation on cash flow and cash flow funding, thinking through emergency funds, establishing savings goals, thinking about the percentage of your income that you're spending on fixed expenses versus variable expenses and how to direct those excess savings that you might have. So again, that's kind of where we're going to be focusing our conversation today. So the first step of all of this is to really think about your goals. Consider your goals. What are we saving for? Is it for retirement? Are we looking ahead to try and give you that balanced and fulfilling life in retirement? Are you funding a large purchase? Maybe you have a goal of purchasing a house and you want to save for that down payment. Maybe you're financing a car purchase or planning a big vacation. Maybe it's your kid's education. You want to plan ahead for that college tuition that we know is coming down the pike. Or perhaps you're just generally investing for your future. Whatever the goal is, it's really important that you have a clear vision so you can really focus your efforts. It helps when you're saving to really have, again, that clear focus and clear understanding of where you're saving. We recognize that, again, saving, as Nicole mentioned, saving for your retirement might not be your immediate priority, but it is so, so important that you get started early. We all know the power of compound interest, and the earlier you begin saving, the bigger the impact it can have on your future. If you delay saving for retirement until you're in your 40s, that might mean you have to compromise on timing, perhaps retiring a little bit later than you would have hoped. So it's never too early to start to think about these things and to set up a savings plan in order to, again, meet your goals.
Once you've identified your goals, it's important to determine the desired time horizon to ensure you are saving properly. For savings goals that you will need to utilize within 3.5 to 4 years, we recommend keeping those dollars liquid in a cash position. Having a separate account may also be helpful to direct contributions regularly to and ensure those dollars are set aside for that specific goal. For instance, I had a separate savings account when I was saving up to purchase my first home, and now I have a separate account to save for vacations. For a savings goal longer than 4 years, then you can consider investing in the market. A longer time horizon allows you to take advantage of opportunities in the market while considering the risk associated with market volatility. This can also be a separate account for tracking purposes, and it is important to calculate how much you should be saving in order to attain your desired end goal. There are numerous calculators available to assist with determining this number. If you Google time value of money calculator, you will be able to solve for a payment or contribution amount for an end future value goal. This can be helpful for determining how much you should save in order to purchase a home in 3 years if your goal is to put 20% of the cost of the house as a down payment. Most retirement plan providers also include retirement income calculators on their website to determine if you are on track for retirement savings. These calculators can provide a realistic idea on how much you should be saving in order to attain a specific goal.
Okay, so once you have the goal in mind and you have the amount required to help you meet that goal based on the payment calculators that Nicole discussed, it's next important to consider the different types of accounts available to you to actually direct these funds towards. So as mentioned, if it's a short-term goal, less than 4 years, the best bet is probably a savings account. This is where you can accumulate cash, earn a little bit of interest, but most importantly, protect it from the market and keep it liquid. If you have a longer-term goal, perhaps you might consider a brokerage account. And this would be a goal that's not necessarily tied to retirement. Maybe it was for, a longer-term second home purchase or something, in excess of 4 years. A brokerage account would allow you to invest the assets. It's presently taxable and you can access it before retirement. If you are saving for retirement, you might consider a self-directed retirement plan. And what we mean by self-directed is simply that it's not tied to your employer. You could establish this on your own. So you could invest in an IRA or a Roth IRA on your own. If you are saving for education for yourself or someone else, you might consider a 529 plan. This is a vehicle which allows you to receive potentially a tax benefit based on the state that you live in, as well as have tax-free growth on those assets if used for a qualified expense such as education. And finally, you might consider some insurance-based products like annuities or whole life insurance.
There are accounts that your employer may sponsor. 401k and 403b plans are defined contribution savings vehicles for retirement offered through your employer. Your organization may also provide a defined benefit plan in the form of a pension or a cash balance plan, again, to save for retirement. Depending on the medical benefits that your company offers, you may be eligible to save into a health savings account for future medical expenses. Due to the triple tax advantage, pre-tax contributions, tax-deferred growth, and tax-free distributions if spent on qualifying medical expenses, this can be a great strategy to save for future medical costs.
So as you can see, there's a lot of different accounts here. So in the upcoming slides, we'll discuss on how to prioritize between these accounts based on your goals. But we did want to kind of pause here and highlight the differences between what's known as Roth and traditional contributions. Now, these could exist, again, within those self-directed plans. You could have a Roth IRA or a traditional IRA, but they can also exist as an option within your 401k or 403b plan within a single account. So the important thing to know about the differences between these two is it's really based on the taxation. With Roth, you're investing after tax contributions. The funds grow tax deferred, and when you take the money out, it's actually tax free. So you're paying the tax when the money goes in. With the traditional, you're investing pre-tax contributions. So when you make a contribution, you're receiving that tax deduction, and it is a pre-tax contribution. The funds grow tax deferred, and when you take money out in retirement, that is taxable income. So if you are investing in a self-directed Roth IRA or traditional IRA, there are some important contribution limits and deductibility limits to keep in mind. If you are single and your income exceeds $140,000, you cannot contribute to a Roth IRA at all. If you're married filing joint and your collective income exceeds $208,000, same thing. You cannot contribute to a Roth IRA at all. Now, a traditional IRA, you can always contribute to it, but the deductibility might change based on your income or your participation in a 401k or 403b plan. If your employer does not have a retirement plan, your contribution to a traditional IRA is always tax deductible. If they do have a 401k or 403b plan, that's where the deductibility is contingent upon your income. So if you are participating in your employer plan and your income as a single person exceeds $76,000, that contribution to the traditional IRA is not going to be deductible. in essence, you're going to be contributing after-tax funds to that IRA. That number is $125,000 if you're married. So again, if your income exceeds this, you can still contribute, but your contribution will not be deductible. One thing to also keep in mind is that if you are married and your spouse or partner does not have income, they could potentially still make a contribution to a Roth or a traditional IRA based on your income, as long as your collected income exceeds those thresholds. And the contribution amounts for 2021 are $6,000 per person, with an additional $1,000 catch-up contribution if you're over age 50. And that $6,000 is collective. So it's not as if you can invest $6,000 in the Roth, $6,000 in the traditional. It's one or the other, or some combination of the two. So you could potentially invest $3,000 in Roth, $3,000 in traditional, or direct the entire contribution to one or the other, but that is a combined limit.
Keep in mind that employer-sponsored plans may have limitations on whether Roth after-tax contributions are allowed. If your retirement plan does allow for Roth contributions, you can actually contribute both pre-tax and Roth contributions to the plan. So for 2021, the contribution limit is $19,500 with $6,500 as catch-up contributions if you are over age 50. You would have one account in the employer plan with different sources of money. This is a great way to diversify your taxes. Another key differentiator is the Roth 401k or 403b component. The plans do not have income limitations. Therefore, if you're not eligible to contribute to a Roth IRA because of your income, you could still contribute to the Roth component of the employer-sponsored retirement plan, again, if available. Now that you've identified your goals and we spoke about the different accounts to save for these goals, you need to develop a spending plan to fund your goals. A spending plan will help you determine where you are now and where you want to go. Without knowing where you currently stand with money coming in and money going out, you can't effectively determine how to pay down debt or plan for ongoing savings. A good spending plan should have broad categories such as food, transportation, housing, entertainment, savings, and debt management. It is important to maintain consistently because your first spending plan may not be realistic and expenses may be missed or undervalued. Online banking and software like mint.com or even basic Excel trackers can help you document your income and expenses and readjust as needed. A spending plan will help you determine your baseline for what's left over to fund your accumulation goals. Start with your net pay stub and list out all the necessities like your mortgage or rent, taxes, utilities. Then list out all of the niceties, memberships, cable TV, subscriptions, the things you don't really need, but that make life easier and more enjoyable. So how much is left over? If your answer is nothing or you're living beyond your current income, trim from the niceties to generate a surplus to be used for that savings or debt reduction. You can also consider supplemental income from a part-time job or a new business. If you don't have enough left over at the end of the month, considering cutting back on expenses like eating out or even rethinking your time horizon for your future goals.
So we have a few tips and considerations to think about as you're going through this exercise. The first would be model this off of your salary. We recognize that some people might have variable income, which make this more complicated, or perhaps you receive a large chunk of your annualized income in the form of a bonus. But generally speaking, it is easier to model it off of your salary and ensure that your bonuses are kind of reserved to strengthen your emergency funds or make lump sum contributions to your goals. We find that, again, basing it off of your salary can provide that strong baseline. We also recommend you set parameters for how you will spend your bonuses or any increases in pay. It's a lot easier to stick to the strategy if you have a set policy in place on how you're going to direct these funds. So one example might be, any windfall or bonus received, you're going to set 60% of that towards debt payments. Maybe 30% of it goes towards savings and 10% you can spend as fund money. It makes it much easier to figure out how to allocate these funds if you're thinking about it in advance. It also helps you avoid a bit of lifestyle creep, right? As you receive any increases in pay, you can kind of reallocate those increases to ensure that your lifestyle isn't absorbing that increased salary. One other thing that we want to point out too is you want to be sure you're setting aside funds for expenses that don't occur monthly. You know, it could be annual expenses or quarterly expenses such as life insurance premiums, vacations. One thing that I saw a lot of was accruing expenses for weddings. About 3 years ago, all of my friends were getting married, and I started setting aside funds to pay for bachelorette parties, you know, wedding gifts, travel, because all of those expenses could really throw a wrench in your budget when, you know, spring and fall roll around, that wedding season, and you want to make sure you're thinking about things like that. One other kind of cash flow management tip that I'd share is that I was having a hard time knowing what was available within my checking account. Despite my parents' best intentions, I really despised keeping a checkbook, but at the same time, I had regular expenses like my mortgage, my car payments that I knew were going to come from this account, and I wanted to ensure that cash was available to fund these payments. So something that worked for me is I set up what I call fixed and flow checking accounts. The way I structured it is that my pay comes into my flow checking, and then immediately a certain amount is transferred into my fixed checking. And I calculated that amount based on my fixed expenses. So things like my mortgage payment, my car payment, my emergency fund contribution, my utilities, you know, things that were fixed in nature, occurred every month, or that I was accruing, I would automatically transfer that out to that fixed account so that I knew I had the funds available to cover those. Then anything left in my flow checking, I knew was available to spend or to use to pay my credit card balance off. I knew the funds in flow were not needed for those fixed expenses. So that's just been one thing that's you know, helped me as I've gone through this process myself.
And if you do have a surplus after funding your goals and paying down debt, consider increasing those tax-favored contributions, whether it be to an employer-sponsored retirement plan, IRAs, or even an HSA account. And life is constantly changing, so expect bumps along the way. Change doesn't have to mean a setback. It can be a time to reflect and then readjust your goals and time horizons. As new homeowners probably know, there can be a lot of unforeseen expenses, and another reason why reviewing your spending plan consistently is so important.
Absolutely. Okay, so with your goals in mind, you know, considering your available cash flow now that you've created your spending plan, we want to talk through this funding hierarchy, this concept of exactly that. What do I do with my money? First and foremost, we'd always recommend that you establish an emergency fund, you know, a basis of available funds that could be used for when expenses arise. Generally, we recommend funding this account with 3 to 6 months worth of expenses. That could change based on your situation. If you're married and you and your spouse are both working, you know, you have the benefit of 2 sources of income. So perhaps you could defer to the, you know, lower end of that spectrum. If you're a homeowner, you might want to go on the higher end of that spectrum. Typically, a lot of the things that we see tapped from an emergency fund are housing related or job related. So if you are a homeowner, you know, you want to keep a reserve for if the hot water heater breaks or if you need a new roof or something like that. So again, this is kind of the basis of this hierarchy, is setting up that emergency fund or establishing your short-term goals. If you were you know, saving for a car or something, that's where we begin.
And then depending on your employer retirement plan features, you may be eligible for an employer match. So we recommend contributing to your retirement plan to at least receive the full match that's being offered. You don't want to leave free money on the table from an employer.
Absolutely. So once you have that base emergency fund and you're contributing to your retirement plan enough to receive the match, Next, we'd recommend you direct any additional cash to debt payments. If you have credit cards or any high interest student loans, we would recommend you address this next. And there are a few different options for paying down this debt, strategies, I guess you could say. One would be called the debt snowball. And this is where you're directing excess cash flow to the debt with the smallest balance. And the idea here is that you're gaining momentum, kind of like a snowball rolling down a hill. You're paying off that lowest balance credit card, getting some confidence under your belt and addressing that next debt. Alternatively, one other option to explore would be paying down the debt with the highest interest rate. So you might have more loans outstanding, but again, you're tackling that highest interest rate and trying to get that paid off first. And once you do have that debt paid off, that's when then you begin to think about, all right, how do I redirect these savings?
And one thing to consider is to fund the remaining amount of your retirement plan up to the IRS limits, whether it be the employer-sponsored plan or an individual account. We understand that it might not be feasible for everyone, but we do recommend targeting between 10 and 15% of your salary, including employer contributions for retirement savings. This might not be something you can do from day one, but ways that you can consider automatically increasing your contributions with increases or changes in pay, or even the elimination of debt and being able to redirect those dollars that were going to debt repayment to increase contributions to your retirement savings.
So finally, once you've, again, created your emergency fund, paid off all of your debt, maxed out your employer retirement plans and IRAs or Roth IRAs, the next would be to fund a brokerage account. And this would be for future goals or supplementals to retirement. If you're a high earner, it's likely that the maximum contributions to your 401k aren't going to be enough to replicate your paycheck in retirement. So the next step, again, would be to fund a brokerage account for that supplemental retirement savings. So where do we go from here? We recommend you create an action plan. First, identify your priorities. Next, consider your time frame. Is this a long-term goal or a short-term goal? Based on that time frame, determine the required contribution. Do you need to contribute $500 a month, $25 a month? What is that contribution that's going to allow you to meet your goal in the stated time frame? Once you have those contributions, develop a spending plan. Again, start with your net paycheck, take out your fixed and discretionary expenses, and determine how much is available left over to meet your goals. Determine on, based on that amount, you might have to cut back your spending or adjust your goals as needed. After you've identified the appropriate accounts, implement automatic features. We really encourage you to reduce friction, set up those automatic transfers, and make saving as easy as possible. One thing we also want to point out is that it's important to consider relationship dynamics. If you are married or in a relationship, consider coordinating with your partner when appropriate. It can really be important to talk through your finances with your partner and make sure that you're both on the same page. It will be much more impactful when you're working towards these goals to have that unified vision. But this is something that you're going to have to review and revisit. A lot of these goals are longer term, especially something as broad as retirement. So it's important that you take a look at your progress over time. Take a second to relish and appreciate all the progress that you've made while also reprioritizing when appropriate. And it's very likely that your goals could change. So again, this is something that you want to look at least every year and consider updating your spending plan as your expenses change.
It can be really difficult to prioritize your goals, and it can help to talk things through with a thinking partner. When you get stuck, because everyone does at some point, consider your team at RTD as your thinking partner. Thank you so much for your time today. We really look forward to sharing additional webinars on topics that interest you. So please let Rachel or myself know what you would like to learn more about. Thanks again.
Thank you all.